Hi everyone, it's Peter Schiff. It is Sunday, June 20th, 2010. Happy Father's Day, everybody. I just wanted to record this video blog because there were two things I wanted to speak about. One was an editorial that Alan Greenspan penned for the Friday Wall Street Journal. And in that op-ed piece, Alan Greenspan raised many of the same concerns that I've been raising and issued many of the same warnings. I mean, first of all, the piece focused on the runaway or out of control federal spending and the fiscal time bomb that was in place as a result. Now, one of the things, of course, missing from Alan Greenspan's op-ed is the Fed's role in precipitating this out of control spending. There is no mention of the Fed in his op-ed at all. He does talk about the fact that interest rates being low are creating a false sense of security and a complacency when it comes to the federal debt. That because rates are so low, it's unfortunate because it's tempting or allowing the U.S. government to borrow all this money. And because temporarily it seems that all this extra borrowing is not having an adverse effect on inflation or interest rates, that it is lulling us into this false sense of security. And he is actually lamenting the fact that rates are so low and not acting as a restraint on runaway government spending. Well, of course, the principal reason that rates remain so low is that the Federal Reserve remains so accommodative. Where are the chairman's harsh words for Ben Bernanke? Of course, he can't criticize Bernanke because Bernanke is doing exactly what he did when he was Fed chairman. If the Federal Reserve had some integrity and exercised some independence, it would be raising interest rates more aggressively right now, forcing both short-term and long-term interest rates higher, and making our politicians deal with the consequences of their deficit spending right now. Instead, the Fed, both under Greenspan and Bernanke, is accommodating this reckless out-of-control deficits, allowing government to get away with deficit spending. Now, Greenspan knows it's only a matter of time before this blows up. He says he'd rather have it happen sooner rather than later. Well, why not bring that about? And of course, it's very easy for him to criticize the debts now that he's no longer the Fed chairman. But of course, he can't criticize the Fed itself. Now, one of the things that Greenspan has said, that I've said many times, is that the argument that we can't cut deficit spending now, that we need the deficits to stimulate the economy, he says that that's flat out wrong. He says, like me, that what would really stimulate the economy is reducing government spending, because that would free up resources for the private sector to really grow the economy. Now, you still have all these economists that believe that by spending money, the government can stimulate economic growth. Well, where does the government get the money it spends? It has to take it from the private sector. It doesn't create new spending, it just changes the form. Money that would have been invested productively in the private sector ends up being spent unproductively by the government. I mean, think of all the monetary or government stimulus provided by communist countries. Think about the old Soviet Union. Look at all the rubles that the Soviet Union used to spend. Look at all the jobs. There was no unemployment in the Soviet Union. Everybody had a government job. But did any of that government spending contribute to real economic growth? Did it raise any living standards in the Soviet Union? No. All that spending delivered nothing because there was no real productivity associated with it. Everybody had jobs, but the paychecks didn't buy anything. The only real economic stimulus in the Soviet Union happened when the Soviet Union collapsed, when the governments fell apart and spent less money. Because as the government spent less, the economies were able to invest more and grow. So the real economic growth didn't start to happen in the Soviet Union until all that government stimulus went away. And Greenspan is basically making the same point now. It's interesting that as soon as Greenspan wrote his op-ed, I think the following day, my old friend Paul Krugman came out and criticized it because his point was that here's Alan Greenspan lamenting the fact that all these deficits haven't caused an increase in inflation or interest rates. And rather than being upset, Paul Krugman says that, well, Greenspan should acknowledge how wrong he is. He should accept the fact that big deficits don't cause inflation, that they don't cause rising interest rates, and that we should charge full speed ahead with even greater degrees of government stimulus. Of course, Krugman doesn't understand any of what Alan Greenspan is trying to say. All Alan Greenspan is saying is that he knows that inevitably the inflation will rear its ugly head, that rates are going to rise, and the more debt we accumulate in the short run, the more painful that reality is ultimately going to be. Now, Greenspan also points out that the only way to deal with this is through massive cuts in government spending. He says we can't raise taxes because that would undermine our productivity and, in fact, result in a reduction in tax revenues. He thinks we need across-the-board cuts in spending, including the entitlement programs, which is exactly what I've been saying. And he says if we don't do that, then all we're going to have is runaway inflation, which, of course, is the real threat. And Alan Greenspan, as Fed chairman, is the one that is most responsible for that threat now looming so large. Now, one thing to his credit, Greenspan points out the price of gold. And rather than being perplexed by gold, like his successor, Ben Bernanke, Alan Greenspan is rightly saying that the reason the price of gold is rising is because of a loss of confidence worldwide in fiat currencies. That is exactly what is taking place. Now, also, along those lines, I want to talk about something that just came out on yesterday out of Beijing. China announced that they are going to abandon their 2-year hard peg of the RMB against the dollar, and they are going to allow the RMB to continue its gradual appreciation that it had up until 2 years ago. Now, of course, the best thing for China would not be a gradual appreciation of the RMB, but to allow a much more rapid appreciation. And in fact, I think that they should have a quick revaluation right now by a greater magnitude, and then allow markets to set the exchange rate of the RMB. But at least this is a step in the right direction, so the damage to the Chinese economy by the peg will not be as great now that they are allowing some appreciation in the RMB. But we have to understand the global implications for a stronger RMB. Number one, it is going to benefit Chinese consumers because the purchasing power of their wages and savings will grow, and it will allow the Chinese to temper the inflation in China that is now actually resulting in strikes, as Chinese workers have been striking to protest high rates of inflation, which of course are the direct byproduct of pegging the RMB to the dollar. But at the same time, as the Chinese enjoy greater purchasing power, they will purchase more things, in particular commodities. So expect the dollar price of commodities to rise much faster with an appreciating RMB than with a pegged RMB. And that is going to be particularly relevant in the crude oil market, in the agriculture market, and I also think in the gold market. I think that there's been a lot of buying of gold in China, and as the RMB gains in value, that will bring down the price of gold for Chinese buyers, making them more likely to want to buy it. So this has implications here. Also for interest rates. If the Chinese are not going to be buying as many dollars because they don't have to maintain the relationship between the two currencies, that reduces the demand for treasuries out of China. That will also reduce the demand for treasuries from other Southeast Asian economies that will now be able to allow their currencies to appreciate. So that will put more pressure on the Federal Reserve to increase money supply even faster, to monetize the bonds that China and other Asian economies no longer want to buy. So this brings forward the problems that Alan Greenspan was addressing in his op-ed, that at some point interest rates are going to rise, and they are going to rise sharply, and we are going to face a Greek-style economic crisis right here in the United States. And if we try to avoid the political pain of cutting government spending, and instead we resort to the printing press, the way guys like Paul Krugman would suggest, then our fate will be far worse than what awaits Greece. We will indeed have runaway inflation, and we will destroy the value of our currency and any chance our economy has of a meaningful and lasting economic recovery. Anyway, enjoy your Father's Day, everybody. I'll be back again soon.